Little known fact about Gregg is that he speaks Polish, and he speaks it live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I just broke my desk with excitement. I am your host, Pablo Gonzalez. With me, as always, the guy with the genius concepts who generates cash flows, and he's a great co-host, so they call him GC. His name also happens to be Gregg Cohen. Say hello, Gregg.
Hello, everybody. Pablo, you have gone from, at one point when you were doing your intro, I thought you were going to break your neck because you're just moving your head back and forth and your hair is like Conan O'Brien, going all over the place. And you continue to step your game up. Now you're breaking equipment. I mean, what's next? Where are you going to take this intro thing, Pablo?
I think I'm going to set up like a turnbuckle over here, and I'm going to just... jump in Randy Macho Man Savage style and come in, brother. All right. Tuesday edition of the Not Your Average Investor Show with Jwb today. Welcome back, everybody that is part of our community. Sean Point. I see Sean Pointer in the house. Welcome, Sean. It's always good to see your face in here. Your name lighting up our screens. Everybody that knows, if you've been here before, this is an interactive show. We want you asking questions. We want you participating. We want you making friends with each other. There's two ways to do that. Number one is the chat function. When that pops open, it defaults to only speaking to Gregg and I, and that is doing yourself not that much of a favor because there's a lot of collective wisdom in this chat. So all you need to do is click the blue button right above where you text and change it from panelist to panelists and attendees. Good morning, Leo in California. And that way you're interacting with everybody else. And the second one is if you want a question answered, the Q&A is made for that, right? So that actually stays in front. I always point this way, like if people know what I'm pointing at. It's over here on my screen. But, I have it here on my screen, and that stays there while I have the chat over here. And you're going to see the chat likes to fly around because people are making friends, people are talking. And so if you want that to happen, use the Q&A. That would be the best place. If not, I'm going to do my best to keep you in mind in the chat as it zooms around. And welcome Lauren Efrat. That's a new name I haven't recognized from New York. Welcome, Lauren. Just FYI, Lauren, you're only chatting with us, right? So your chat is defaulted to only panelists. If you hit the blue button, put panelists and attendees, now everybody sees you're awesome. There you go. You got it. Welcome. If this is your first time joining us and what you want, you're about to get a sweet breakdown of the rental income property market, the views of 1,000 square feet of JWB's amazing data points of everything that they touch here in Jacksonville and in real estate in general. But if what you're looking for is just a simplified guide to rental property investing to passive income, Gregg put together a really, really nice looking guide a couple of months ago, and you can find that at jwbpassiveguide.com. I'm going to put it in the chat in a second, but I highly, highly recommend you go check that out. And in the media biz, we call this a teaser. We also got a golf tournament coming up, and we got a raffle, and that's got a really, really great cause. We're going to talk about that a little bit later of how you can enter this raffle, maybe make some money if you're feeling lucky, and help an amazing cause. So we're going to talk about that in a second. But for right now, Gregg, we're going to talk about Q1 2021 JWB market update. Kick us off, my man.
I mean, I think it's a really cool time for us just to reflect. I mean, Q1 2021 is exactly 1 year from when we started this show, from when Pablo and I came up with this harebrained idea and put this together. And I remember starting in January, and Pablo, you kind of led the path and said, hey, here's what I think we should do. And I was following, I was super excited. And we thought that we had an idea of how the year was at least going to go. And then what we realized is by the end of February and going into March, the entire world had changed. And I didn't realize how important it was to have this platform to be able to talk with all of our friends here on the show and to talk with all of our clients on a regular basis. I didn't realize how important that platform was. But as I think now about what transpired in 2020, it was the single greatest thing we ever did from a messaging perspective, from a client service perspective, from the ability to help a lot of our investors and those who are thinking about investing make great informed decisions. And so I'm so thankful. I'm so thankful for everybody who was here in the very beginning. I see a lot of those names here who are here as well. Lee Bishop comes to mind. Lee Bishop has been a part of the show from the very beginning. And not only was he on the show yesterday for the client only meeting where we went over a lot of these concepts, he's here today too. So, that means to me that it's a lot more than just the information that you all are here to get. It's a community. It's a support group. Lee's here to make sure that Pablo and I don't screw it up too bad on this one. And, I'm so appreciative for everybody who is a part of this community. I also just think, wow, as I was sort of putting some of these numbers together towards the end of 2020, we'll go over these numbers here in just a few minutes here. But, now we have the benefit of hindsight. And I think, hindsight is what we really all wanted when COVID broke, right? We wanted some ability to see what was going to happen. It was a pretty scary time for everybody. And when COVID broke, I was scared too. I think everybody in the world was scared. And so I remember at that time thinking, okay, let's go back to the data. Let's go back to our experience. Let's project forward because people need answers and they need insight into where it's going. And it's really cool now to see how things have transpired because Pablo, you and I talk a lot about in the beginning when, a lot of the fans of the show were asking questions about what's going to happen with rent collection, what's going to happen with home prices. And, I came strong and I said, especially on the home prices front, I don't think things are going to slow down. I don't think home prices are going to go down. And there were a lot of people who thought I didn't really know what I was talking about. But now we have hindsight. We have the data. We've been, a part of coronavirus economy now for a long time. And it's really cool to see how some of those ideas that we have transpired. And of course, spoiler alert, a lot of those things turn out to be, exactly like we said. And I know that helped a lot of people along the way as well. So super excited for us to go through this breakdown, my friend.
I'm excited too. I hadn't really thought about it, right? But yesterday's client only call was this report that we made, but today really is a kind of full circle, right? Because it was on the show that, listen, full disclosure, when we launched this thing, I was just thinking this is a great marketing initiative. And I knew that it would lead to community if we go about it with the right intentions and whatnot. Never in a million years could I have seen COVID happening. And quite frankly, I think COVID, again, has accelerated all these trends that have happened around. And this happens to be what we're doing, I believe, is a trend that great companies will adhere to, right? Like having your own broadcasting platform to speak to your clientele en masse, connect them to each other, see the value of your clientele and offer it up to each other so everybody can make these magical connections. But I mean, I was nervous, man. Like I didn't know, I knew that you were going to show up. You had some very fortified, data-based, experience-based beliefs on what was happening. And you weren't super sure about how to, how strong to come with it. I had this feeling that whatever you're doing, you're going to get another at bat the next week and the next week and the next week. So we can always refine it. But man, I had no idea if your belief in the market was going to hold true. And, I guess, I don't know.
Did you think I was crazy when I said the prices weren't going to go down?
No, man. I don't know. There's something about how you talk that makes me believe you, first of all. And the longer I've known you, I know why. You're very measured with your words. You really take to heart this whole like under promise, over deliver stuff. But I was nervous. Listen, I was less nervous about that and more nervous about people coming en masse and panic to the show. But what we found was just people coming looking for someone to talk to them like a friend and talk to them as if, like you're not trying to sell anything, which we really were just always just here to be transparent. And I think it is one of the things I have to say, I think COVID is one of the things that really gelled this community together. And given my last partnership, my last experience where it was a leader that disappeared in crisis, you were the complete opposite, which to me spoke volumes of the guy that I'm kind of building a company around, you being my client at that moment. Right. So, and still am today, by the way. So kudos to you for all of this stuff. And I'm glad you contextualize it like that, because there is a different feeling to doing this on the show versus doing this in front of clients.
Yeah. Well, thank you for all those nice words, brother. Let's get to the real data here. I think we've got some really good information and insight to share with everybody. So let's rock and roll.
Let's go, man. All right. Talk to me about some KPIs, Greg.
Yeah. So the first thing I always want to start with when doing a real estate update is the thing that you all are going to be paying most attention to. You, of course, being those who are investing in rental properties currently. You're going to be paying attention to rental income. You're going to be paying attention to the money coming in. You're going to be paying attention to your houses being rented very quickly. And you're going to be paying attention to your leases being renewed. And Pablo, are you trying to screw me up here, man?
I'm not. I promise. But we got it right now. We got it right. It just took me 3 times.
Oh, man. So what I did is I put together our annual numbers. All of the numbers that I'm showing you here are how JWB Property Management has fared through the entire year of 2020. And a great ability now for us to look at the entire gamut of what we were able to do in 2020 and think about what are some of the things that we said in the beginning of 2020 when COVID broke, right? So we'll get into the numbers here in a second. But one of the things that we talked about a lot that I felt very confident in when COVID broke was that I didn't know exactly how this was going to play out, but I felt very confident that people had been investing in rental properties for a long time because it is known to be a consistent asset class, much more consistent than the stock market. And there was a real need for consistency when COVID broke in all areas of our lives. And the reason that it's at the base level, the reason why it's such a consistent asset class is because you're investing in a critical need. And it's a critical need for the individual to have housing. It's also a critical need for the government for housing that sector to perform well because it affects so many other sectors in the economy. And so it was with that mentality that we said, listen, I don't know exactly what's going to happen. It was impossible for me to know about rent collection at that point in time. One of the things that I shared with folks is, I'm a rental property owner myself. I have hundreds of rental properties. And so I felt the pain of thinking about, a large part of our economy becoming unemployed and wondering what that would mean before the stimulus came. And I just came and shared with everybody that I thought there would be a short-term temporary loss of rental income, meaning that I thought our rent collection numbers for 2020 would be noticeably below where they were in previous years. Excuse me, because I just didn't see it any other way. And so now, with the benefit of looking at what happened in 2020, take a look at some of these stats, guys. All right. Rent collection numbers, historically for JWB, we collect about 98.5% of rent. Through the entire year of 2020, which was mainly a COVID year, we collected 98% of rent, which is an incredible accomplishment for our property management team and much better than I prepared you to expect, when COVID broke. So super proud of that. Our current properties under management continues to rise. We now have 3,700 homes under management, continues to rise. Total rented houses, that means the number of new houses that were rented and moved in the year 2020. And we rented and moved in over 1,100 new residents, which is a huge world record by far for JWB. You'll see how we compare to previous years in a couple of slides here, but a huge world record there. Our average duration of lease sign continues to stay very strong. As you know, we focus only on long-term leases. And the reason that we do this is because long-term leases lead to long-term resident stays for you, and long-term resident stays lead to return on investment goals being hit by you. And so our average duration of lease sign is between 2 and 3 years because we sign those 2 and 3 year leases. Check this one out though. The percentage of leases re-signed at 71%. I don't feel like we give enough love to the lease re-sign process and our property management team who's responsible for this, but it is one of the best ways for my team to produce a return for our clients and to beat our return expectations is for us, after signing a long-term initial lease, for us to renew that resident to sign up for another 1, 2, or 3 year lease. But we hit a world record there on the property management team. 71% of leases that came up for renewal in 2020 were renewed, which is incredible because residents at this point in time, whether they were looking to move to find a new house to rent or whether they were thinking about if they wanted to renew, they've never had more challenges on their finances and more variability in everyday life than they had in 2020. So for our team to be there, have that relationship and help them see that this was the best value for them to re-sign, it's an incredible accomplishment, and it hits the pocketbook of all of our investors. All that leads to an average duration of resident stay, another world record for us. The average resident stays 54 months in a JWB home, which is the end result of a lot of hard work, a lot of relationships with our residents, and systematically signing long-term leases and then renewing them. And our current occupancy at the end of at the end of 2020 was 97%, a huge win for us as well. So I'm super thankful that our property management team they're just so talented. They work so hard. They have put in the work to be able to have these incredible numbers. And these numbers are so much better than I thought they were going to be when COVID broke. And it's a reason that, that we talked about this asset class being consistent. Well, this is overperformance and showing a level of consistency that I don't think anybody expected.
Totally, man. I look at these numbers and they look like a great year. And while I tend to expect a great year out of JWB, the idea that this great year happened while the world was completely upside down is a really remarkable thing, right? Like if I am to recount, I would guess that you thought that rent collection would go down much more than 90%.
Do you want to know what we projected? Once COVID broke, my business partners and I sat down and we redid our entire business plan. And we looked at each other and we said, what do you expect rent collection to be? And all of us were like, I don't know. I have no idea. Like, there was so much in flux in the world. So when we sat down and we redid our business plan, we expected 70% rent collection. Now, these are four guys that own hundreds of rental properties, that managed 3,500 rentals at that time or whatnot. We have a lot of experience with this. And that was sort of similar to those in the industry as far as what you could conservatively expect. Now, for every business plan we put together, we're super conservative because a lot of people depend on us being right. But 70% was our best guess. So to show up at 98% for this year, I just can't tell you how proud I am of our team.
It's remarkable, man. The other thing that I think is very, very telling, and I'm going to get into a couple of questions right now, but this total rented houses, that's the amount of people that moved into a JWB house in 2020, right? As opposed to just total properties under management. That's how many residents you have. So this idea that you were able to bring in 1,139 new tenants, the story behind the scene there is being way ahead of the curve on technology, having, electronic lease signings, being able to see properties virtually, having all these, like, I remember being in a meeting prepping for the show and you guys going over this like lockbox kind of like remote viewing procedure that was happening. And to me, that is operational foresight and efficiency, which I think is really, really remarkable.
And it wasn't that long that we had just streamlined the remote showings process with the lock boxes to be able to scale up, to be able to do this. It wasn't that long before COVID broke. That was a project that Kate Sutherland on our team spearheaded. And it was, I believe, in December of 2019 that she made this happen and that our team was able to implement this. We had been doing remote showings for many years prior to this, so we were fully aware, but she brought this level of scalability. So, I think there is some foresight there. I think more than anything though, it's our team. It's the talent that we have. It's the culture that we have. It's the ability to see obstacles and understand that they're just obstacles, right? We can figure out a way to solve this just like we've solved everything else. And so I think it's the attitude of the team more than anything that's really reflected here.
And speaking of team and speaking of consistency, Miguel Angel Sanula has a great question. I guess JWB company health is awesome too. Any jobs lost? Any financial stress?
It's a great question, Miguel Angel. And that's, I think, one of the things that we did right as far as leaders of the company. When COVID broke, we sat down, we redid the business plan. And that was important for us to see in a COVID affected economy. What was the worst case scenario that we could expect for JWB? And, the really great thing is that we had been preparing for a rainy day at JWB for many, many years. We've had a number of successful years here at JWB, and we learned early on that, things can change and that we look at the responsibility that we have to the 80 families that are employed by JWB, but the hundreds and hundreds of other people that are a part of our organization. And we said, you know what? we need to make sure that we're planning for a rainy day because we don't know when it's going to happen, but we've been a part of rainy days before and we know what they feel like. So when COVID broke, we sat down, we redid the business plan. We saw really where our finances were. Even if we had to slash our sales and slash rent collection and slash all of these things, we said, okay, where are the resources at? And we felt really good about our runway. We felt that although the world was flipped upside down, that we were in a position of strength. And so immediately, as soon as we redid that business plan, the next day we got on a meeting with our team. And the message was very clear. It said, nobody needs to be worrying about their job right now. Your jobs are safe. Just go out and crush it. And so not a single job was lost to COVID. That was the message that was received by our team. And I think that calmed a lot of fears for our team. And then it just allowed them to be the A players that they are. So yeah, so the company has had an incredible year. It's been our best year ever in 2020, and we're even more solid and stable than even prior to COVID, which is nice to be in.
Yeah, that's amazing, man. Really, really cool. So I'm just going to set up the rest of the stage here. We're going to talk about the difference between these, this is the year-end snapshot. We're going to talk about what the COVID effect was real quick. We're going to talk about where we are in the market now. And then we're going to talk about housing pricing data, so you understand where you are in the market now. And then we're going to talk about current Jwb inventory. I say that because Nadeem, I know that you got a question about inventory. We're going to get to that in a second. So Greg, why don't you kind of just give us a little breakdown? I think we can go through this pretty quickly, but
yeah. So a lot of folks ask, what was the COVID effect? And now, because we're looking at a full year of 2019 and a COVID year in 2020, we can realistically look at what the COVID effect was for Jwb. As I mentioned, rent collection was very close to what we have historically done, which is a huge win. Actually, in 2019, we collected 98.7%. And then in 2020, we collected 98%. So, there is a COVID effect there, but to be within 1% of rent collection when you've been experiencing an eviction and a foreclosure moratorium, and you saw record unemployment all of a sudden, what an incredible accomplishment for the team. Lease renewals in 2019 were 66%, which is incredible. I don't know of another property management company that, number one, tracks lease renewals, and then number two has 66% of their leases renewed, but 71% in 2020 sounds even better. And so super proud of that. Homes rented, we experienced a big jump as well in 2019. Just 1 year ago, we ended the year with 975 homes rented, which is incredible. That was the most we'd ever had before. And then in 2020 to jump up to over 1,100, a really important metric for all of our health and safety of your investments there. So really exciting there. And then evictions in early terms. This is an interesting one. I put this one here in full disclosure. Of course, there is an eviction moratorium going on right now, which means that the vast majority of evictions can't go through. But we have some really great data, and we can make an assumption and be pretty confident to see about how our eviction rates would have fared. And so with that information, we had a 1% eviction rate in 2019, and in 2020, it really should come in somewhere right around 1.1%. This is assuming that our historical rate of evictions once filed would actually go to completion. So again, what we're able to do there is we brought people to become a resident who were qualified. For folks that have fallen on hard times, we've been able to work with those folks, come up with solutions to make sure that we're treating them with compassion. And our evictions number really shouldn't have risen that much, even in a COVID year as well. So really, really, and out of all of the stats there, that was the one that shocked me the most when I was putting these together. I was like, wow, this is really working very much like normal for this asset class.
Yeah. And we're going to dig into these evictions in early terms. I want to frame it around Margaret Smith's question, which is, so I assume your business success, i.e. rent payments in and on time, was truly tied with the job market in Jacksonville. I mean, if you have no job, you can't continue to pay rent, right?
Well, there's a lot that you can do, even when people are falling on hard times. Like, for example, there is a program in Duval County which took some of the CARES money, the stimulus money that was given to Duval County, and now is a fund for basically eviction relief that residents can actually apply for and get relief so that they can use that to pay the rent if they have been able to show a hardship. This has been out for months now. And so when something like that comes to be, my team is all over that. We're looking at how can we become really big advocates for that type of a program for our residents who do fall on hard times. And there's other ways that we can work with other charities that can provide rent assistance. So it's not really that cut and dry that, if somebody's unemployed, that they, are going to go into an eviction. Our team puts a lot of hard work into that. Now, granted, if somebody is unemployed, that's a much more of a leading indicator that you could have a challenge. But our team's done a great job of mitigating really difficult situations and by and large keeping our residents in our homes.
Yeah. So there's all these programs and all these externalities, but I think it's all also very driven by a very proactive relationship that you have with renters as well, right? What would you say the effect is there?
Oh yeah, that's at the core of everything that we do. That's the reason why people renew 71% of the time. They all have a choice to go out there and change and go and work with somebody else who's going to be another property manager. And if you have that choice, but you 71% of the time make the decision to keep working with the team that you have, that's no greater reflection. That's repeat business, right? Repeat business is the greatest statement that a potential client can make about the quality of your service. That's repeat business right there.
Yeah. And, I took a call with this young entrepreneur yesterday that was thinking about building out all the scale so you could go get all these clients and this and that. I'm like, listen, man, what you need to worry about is your lifetime value of your client, right? Like how long your client sticks around. And I kind of give him the story of how we started and how it's built up. But, as a landlord, your LTV, your lifetime value of your client is how long they stay. So, putting in the work to keep a client that you have, as opposed to just bringing in more and more clients as a business decision is always good.
Absolutely.
Yeah. Miguel Angel Sanudo asks, what is the data you like less and why? I assume at some point in there, you're talking about data that you like more or less than the other.
Well, I don't know. I don't know what we were referencing there specifically, but I think this slide that we have up is some really great data because I'm always trying to think about as I am a rental property owner, as you who are thinking about rental properties, I'm trying to see, okay, well, those stats look really good, Greg, but where could the pain point be that's maybe just not reflected there? So that's what this stat is really reflecting. I wanted to see for those people that are sort of in an in-between stage, they're not in an eviction, they're not current. What about that in-between stage? Do we just have a whole bunch of people that are piling up with huge deficits that would need to be paid off, right? Because as a property management company, you could just keep people in that stage, not technically file an eviction, and really have big problems with your portfolio. And so that's what I wanted to show here. It's our current payee status. This was at the end of January 2021. And the main thing that I want to look at here is you can see 95% of our residents at the end of 2021 were current, got a little bit over 1% in an eviction stage. And again, there is a moratorium right now, so you can start the eviction here, but for most of the time, you cannot complete the eviction. So you've got people that are just sort of in limbo there, right? But the stipulation agreement is something that we do on the property management side, which can be a huge asset for you and for your resident. Stipulation basically means that we start the eviction filing so that that process is started on your behalf if there's a resident who can't make payments and we can't figure out another solution. But as soon as we do that, we are in communication with the resident and we say, this is not the end all be all, right? We do have to start this, but let's try to figure out a way. And a stipulation agreement is basically a court approved payment plan. And while you enter into a stipulation agreement with your resident, or Jwb does this on your behalf, there's an agreed upon payment type. They have to be completely paid off, including any eviction fees, so that you are whole as the owner. And while the while the stipulation is taking place, that might take a week, 2 weeks, 6 weeks, whatever is realistic there. As long as they're hitting their payment dates, then we put the eviction on hold. The moment that they do not hit the moment they do not hit a stipulation date, then the eviction proceeds. And so it's a great way to do what we need to do right by you to start the eviction, but also continue to work with those residents. And what we have seen, and this is so surprising for many people, but 50% of those who enter into stipulation agreements historically pay them off completely. When I heard that the first time a number of years ago, I was like, really? That's amazing, right? So we look at this as a huge opportunity for us to again, work with residents, get them fully paid off, keep them in your homes, which is the best thing. And the other thing to keep in mind here, so you got about, call it a little bit around under 2% of our residents were in a stipulation agreement at the end of January 2021. But those stipulation agreements do not have a huge dollar figure that they have to pay off, right? If it was like a $10,000 figure, then that would be, to me, I'm like, listen, nobody's going to pay that off, right? A resident's not going to pay that off. I was really excited to see that all the 65 residents that are currently in stipulation agreements at the end of January 2021 owe less than $3,000 on their stipulation agreement. So what that should communicate to you is that we're very thoughtful about who we put into a stipulation agreement. We only do it if it's going to be the right thing for the owner and the resident, meaning if there's a chance that it's going to be paid off. And when I saw that, and I saw our eviction percentage, and I see how our current Payee status is really high, that should give everybody the confidence to know that this asset class really is performing consistently, especially with JWB here, which was the premise that we started with when COVID broke. Right? This is a performing asset class, and especially with JWB's expertise, we're able to make sure we deliver consistency.
Love it, man. Consistency is the name of the game. So speaking of tenants and owners, residents and owners, Mike Foster has a question. When JWB determines it has come time to evict a resident after working with them, do you permit property owners to override that decision if we want to allow the person even more time?
Yeah, we're in communication with our owners all the time. And so if there's a resident issue, we're going to be talking about it with you as the owner. I wouldn't necessarily frame it as like we take an action and then you override, right? It's just a mutual decision that is agreed upon. Now, I mean, most of our clients are going to rely on us to do what we think is the best thing, because that's probably why you hired us, because we have all this experience, and you probably live in California or New York, or, Mike happens to live in Atlanta. So you probably came here with the idea that we'd probably lead the way as far as determining what the right thing for you to do is. But if there was an extenuating circumstance, we're certainly going to work with our owners and make sure that, their wishes are fulfilled.
Cool. Speaking of living in New York, Lauren Efrat has a question. Are you finding that it is more difficult to raise rents at the end of a term during COVID?
We are not finding that it's more difficult to raise rents at the end of a term. Although I should clarify, so there's two ways that we can go about it at the end of a term, right? If you're a current resident and then you come up for renewal, you still will see a rent increase in your renewal, right? If you sign a 2-year renewal, then the first year you won't see an increase. The second year, you'll see a $50 increase. If you're in the third year, or if you sign a 3-year renewal, the first 2 years are kept the same. And then the third year of the renewal would see a $50 increase. So you're able to get rent increases while continuing to see long-term resident stays and renewals continue to go down that path. So that is very well received, because that's a huge win, especially as rents are rising right now. The other part of this would be if the resident moves out, then we're able to raise the rent. And sometimes the market rent has actually gone up even higher than what you would have had if you only got the renewal. And rents are rising here in Jacksonville. So from an owner's perspective, you're protected either way. Your best protection is to keep your resident in your home, because you save money on all the other costs that come along with a turnover, but you still do get rent increases over time when you renew. That's your best play. That's why we love renewals more than anything. But if that resident does move out and we have those expenses to incur, many times you're able to go right to market rent, which might even be a little bit more than if you had kept that resident in there.
Beautiful, man. Couple more questions on this stuff. Ken Moline asks, can you comment on late fee collections or forgiveness during COVID?
Yeah, as a part of the CARES Act, we did not and could not charge late fees as a property management company during COVID. And so we did not charge late fees to any residents. I don't remember when that changed exactly, but probably ballpark it from, call it March to maybe October. Late fees are something that we used hopefully to change behavior, to get your rent paid on time. So we have started to charge late fees again. I don't remember exactly which month, but towards the end of Q4 of last year, we started to charge late fees again. But our stance with late fees is that we want to work with a resident to pay on time. And if we can encourage behavior to get that rent paid quicker, we are really quick to waive late fees. for residents. That's always been our thing there. So it's back to normal as far as late fees for charging for if the rent's not paid by the 3rd, there's a $150 late fee that is charged to your resident. Again, that's meant to, modify behavior so that they pay before the 3rd.
Cool. And then final question based on evictions and COVID and whatnot. But Miguel Angel has another question that says, do you have any statistics around the chances that you receive any kind of compensation from people that have been evicted?
So the chances, what I'm understanding is the question is somebody has been evicted and they may have, lost rent or past rent that they owe, or maybe they might have damaged the home, right? And what's the chances of you actually collecting that money after the fact? Not high. For myself, I chalk it up as, it's not worth it for you to spend good money going after bad money is a common phrase. And you would have to, take it to small claims court much of the time, and you're just not typically going to receive it. We do have a collections company that we can refer our clients to, and they can do the dirty work to put all that work into it. And then when they do collect, they're able to keep a percentage of it, and you're able to keep a percentage of it, which is like found money is the way I think about it. So yeah, so I wouldn't count on it if they go to eviction.
Okay, so the rest of the questions we have, Nadeem, Raja, Lauren, Lee, and Sean, all kind of have to do with the market and trends in the market. So I kind of want to tee you up to just give us a snapshot of where we are right now, Greg, and just letting you know it's 1:08. So we kind of want to go through these slides, maybe about 3 minutes a slide kind of thing.
3 minutes a slide. Here we go. Okay, so here's a snapshot of where we are from 2001. And this chart actually goes all the way to present day, 2021. And the most important things to note here are that red line that goes up. Well, yeah, there we go. The red line that goes up, that's the median expected home price in Jacksonville. And the way you get that is by looking at the past. And when you go back from 1991 all the way to present day, and you look at what home prices have actually done in your market and in Jacksonville, you're able to understand what the average annual home price appreciation rate is. And then Jacksonville, that's 4.3% per year. And that's a lot higher than the national average. So that's something to take note of. Well, when you know that, and you know how real estate cycles work, one of the core strategies that we invest with here at JWB is that we expect the historical norms of home price appreciation to come back after the next full market cycle. And a full market cycle is between 10 to 20 years. And that's how things work. If you go back and you look at 10, 15, 20-year segments in your market, and you compare that to what your average historical appreciation rate is, it's going to be very similar most of the time. So when you know that, you can start to predict what your median home sales price should be. And this is important because a lot of folks are asking, especially in the internet and a lot of Facebook groups and chat rooms and whatnot, are we in a bubble right now? Are we in a bubble, right? And what they see is that prices have been going up higher than average, especially since 2011. What does that mean? Does that mean that we're in a bubble? Does that mean that things are going to come crashing down again? Nobody really knows unless you have this type of perspective. And that median sales predicted line is one thing that we use here at JWB to understand where we are and to advise clients. So the really interesting thing is you just heard me talk about how real estate cycles tend to repeat themselves. Pablo, knowing what you see here, the big run up from 2001 to 2006, then the big drop all the way to 2011, and then the run up since, would you say that this is probably a more variable time in real estate pricing in Jacksonville than the norm?
Right now?
Well, this 20-year segment.
Oh, I mean, spoiler, I know that this happens to be 4.3% appreciation that we're seeing on this red line. So I guess it's right in line with everything that you talk about.
Yeah. And, we didn't have this huge run up and then drop and then, subsequent run up in the last 20 years prior to this graph, right? We had the biggest run up of prices and then the biggest crash since the Great Depression. And we all know that as the Great Recession. So this is the biggest challenge to that theory of is history going to repeat itself was probably right here in this 20-year segment of time. But what you see is, just like Pablo mentioned, from 2001 to 2021, we are right where we should have been on that historical home price line right there, right? We are right there. So that's the first indicator. When you're wondering about where pricing is going, look and see where you are compared to your historical home price line there, the predicted line. When I see that we're right where we should be, that doesn't tell me that we are going to see a huge increase in prices. It doesn't tell me that we're going to see a huge decrease in prices. It's just letting me know that we're right where we are. So that's point number one. The second point is going to tell a little bit of a different story. And that's what we're going to talk about when we get into months of inventory.
Let's get into months of inventory.
All right. So I pulled the data from 1 year ago. This is from the multiple listing service here in Jacksonville in Northeast Florida. So you can see where we were prior to coronavirus. The median home sales price was $240,000 1 year ago. Homes on market was 6,600 homes on the market. Now, for comparison's sake, that's really low. Okay. So I know what it felt like to have an oversaturated market, because in 2006, I bought about 40 rental properties with every dollar I owned, and I financed them to the hilt. And that was before I had any experience in this. And then the market subsequently dropped from 2008 to 2011. So I know what that feels like. We had 16,000 homes on the market when the market really crashed in 2008. Now, January 2020, so 1 year ago, we had 6,600. So that's really low. And then home sales, 2,000 home sales in January. It's pretty normal for where we were prior to coronavirus time. But what that resulted with is low inventory. Normal sales gave us a months of inventory number of 3.2. And months of inventory is that second data point that you're going to want to pay attention to if you want to know where home prices are going to go. Between 6 to 7 months is known as an equilibrium market. And the way that you get that 3.2 is you just take, the number of homes on the market divided by the number of sales, and that's how you get 3.2. And we've been tracking this for every month since 2014. So 6 to 7 is an equilibrium market. If you're below 6, that's a seller's market, and you'd see upward pressure on pricing. And if you go above 7, the farther you go, that's when you would see downward pressure. And really, it's not like you get to 8 months of inventory and you're going to, see declines in prices. It would mean that you should see lower than normal home price appreciation when you get over 7. So this is what we saw prior to coronavirus come. And when you all asked me, what did I think about home prices? I didn't think that they were going to go down because I was looking at 3.2 months of inventory. But Pablo, you are Johnny on the spot, brother. Thank you for
Johnny on the spot. And I'm just going to say that when you were like, yes, 3.2, that was where you were going, right? Like where we started this call and you're like, listen, man, I just think we got to tell people that prices aren't going to drop. You went as far as thinking maybe in the very short term, it drops for like a blink, but it's not gonna, it's actually, you said maybe they won't go up, but they're not going to drop because of this 3.2 months of inventory. And now here we are.
Yeah, exactly. And the thought is we ran the numbers and we said, if demand dropped by half, like if you had 2,000 sales and you dropped it to 1,000 sales, that would still get you to like 6 to 7 months of inventory. And we just didn't see that happening. And so that's why we didn't think that prices were going to drop, right? It's pretty simple, right? It's not, I didn't come up with any like crazy algorithm. That's just what we were looking at. It's nice about real estate. You don't have to be the smartest guy in the room to understand this. So January 2021, look at what happened over the past year. Our median home sales price has gone up, right? $267,000 for the median home sales price in Jacksonville. Our homes on the market, the inventory number dropped a crazy amount. 4,200 homes on the market is stupid low for inventory. It has never been lower for inventory here in Jacksonville. And the drop in inventory from 6,600 to 4,200 in 1 year is insane, right? If you're trying to buy a house here, if you're a retail homeowner, you're trying to buy a house here, you just can't do it unless you come in with an all cash offer, you pay way above list, you don't have an appraisal, right? It's the market is, there's just no supply.
It's really hard, right? Speaking from experience, when I kind of dip my toe into, do I want to buy my own home or buy a rental income property? Lee Bishop, you put, what does YOY mean? Year over year. For me, it was, I would get an email from, actually Alex is sending me these emails. I'd send it to my real estate, my real estate broker, and everything was gone. And this was 6 months ago, right? So like it is flying.
And 6 months ago, we had months of inventory around probably 2.5.
Yeah.
Right. So look at what happened. Homes on the market dropped significantly. So your inventory is down. Home sales has skyrocketed. It's up 50% year over year. And that just doesn't normally happen. And this isn't the only month that it happened in January 2021. We hit, for the first time in Jacksonville's history, we hit 3,000 home sales in a month, and that happened in June of 2020. And almost every single month since then has been at least 3,000 sales. Here's a crazy thing that if you're a real estate nerd like I am, you look at this and you say, wow, this has never happened before. Every other year, the peak of home prices has come in the summer months because that's when people are out buying homes, and that's just generally how seasonality works. December of 2020 was the first time that December's pricing was higher than any of the summer months. It's never happened before. So we are seriously seeing that the low supply and the high demand is increasing home prices. And we feel that that's here to stay. And the simplest way to categorize this or to put a number on it is months of inventory. We're now at 1.3 months of inventory. We've never seen it that low before. So as you can see at the bottom of the slide there, I'm sharing with all of you that our prediction for the year 2021 is that we're going to see higher than normal home price appreciation in Jacksonville to the tune of 8 to 10% year over year appreciation in 2021.
Makes a lot of sense, man. So now let's talk current JW. Oh, you know what? Let's go back to a couple of these questions that we have here.
Mm-hmm.
Lauren Efrat asks again, what percent are you seeing rents increasing in Jacksonville?
Rents are going up as well. That data is a little harder to come by, but generally rents rise between 3 to 4% a year. And so somewhere around maybe about 4% or so is a good figure to use. I've seen that a couple of times in some of the data sources that we have.
There you go. All right. So now here's what I would like to do, Greg. I'd like to go over this current Jwb inventory. I want to talk about our raffle, and then I want you to give what your overall recommendation is. And then we'll go through the rest of these questions that I think we're going to be able to fly through real quick. You ready?
Yeah, absolutely. So from an inventory perspective, a lot of our folks who are watching on Tuesday also join us on the Thursday show when we do the property of the week. And so if you want to see this in action, definitely join us on Thursday for the show. But this is just an overview. So purchase prices now are between 160 to 250,000. That includes both renovations and new construction homes. Renovations are a little bit on the lower side there, and new construction are on the higher side, as you would expect. Estimated returns on investment, not including home price appreciation, are between 8 to 10%. And that's assuming that you're getting conventional financing. If you're buying with cash, it's a little bit lower. And your interest rates that you should be able to get on your conventionally financed loans, we tell clients to expect 4%, which is incredibly low. This is really the deal right now. When I think about it, your ability to secure debt at 4% is an incredible asset for you. So if you have questions about how to use debt in a smart way, this is the time to invest in your education, because I believe more generational wealth is going to be created because of this lending environment, this debt environment that we're in, and also coupling that with hard assets going up in value like we're talking about here in rental properties. And the inventory type right now, it's mainly going to be renovated homes. And the reason here is we love renovated homes and we love new construction homes. And the main reason that you're seeing mostly renovated homes right now is because when COVID broke, one of the things that we did, really the only part of our business we changed, I would say dramatically or put a pause on, was the building. And instead of building maybe 30 or 35 homes a month, we built maybe 15 or 20 or so. So we scaled that back because we just wanted to see how things were going to go. And you're seeing some of that because it takes 6 months, maybe sometimes more, to actually build homes. And so you're seeing some of those effects now. But the even bigger reason is because everybody and their mother is trying to build homes right now. So the building department is completely overrun. Things like getting permits do not come quickly anymore. Solving any challenges that come with an inspection or even sourcing some materials is a problem. And this is a problem for everybody in the industry. So it's taking longer for us to build at the moment. And so if you're in the market right now and looking to pick up some JWB rental properties, most of them will be renovated homes, which I said, we love both renovated homes and new construction. So we're happy with both.
All right. So a couple of things on that interest rate. Nadeem Shah puts, he just got 3.1% rate. I just closed on my property. I had 3.6%. So Nadeem, you beat me. Congratulations. And we have a couple of Nadeem also had a question from before. He asked, how many properties does JWB own, and how many properties are investor owned out of all the ones that you had talked about before?
So my business partners and I own a little over 300 properties that are in our company portfolio, and the rest of the properties that we manage would be investor owned.
Cool. And then Raja Bontu asked, when do you expect new houses to be available for purchase? Are they just kind of like coming up as they happen, or what's going on there?
Well, if you're interested in new construction, I would encourage you to reach out to my team. So, I'm just kind of preparing you. Most of the offerings right now are renovated homes, but we do have some brand new construction homes as well. So it's not like there are none and that we have to wait for, 6 months before we get them. They're just sprinkled in right now. And the majority of the purchases will be renovations at the moment.
All right, Greg, before we give our overall recommendation and go through a couple of these questions, really good questions, by the way. I'm really pumped to talk about Margaret Smith's question because it's my favorite macro trend topic that I love talking about. But what's going on with the golf tournament? How can we help? What is this raffle about? Why don't you tell our friends about this?
So February is the best month of the year for JWB because it all leads towards our charity golf tournament, which is coming up on Monday, March 1st. Which we have the best MC in the history of MC is going to be at the golf tournament, Pablo.
Yes, I have been promoted to golf tournament hype man.
There we go. Super excited for your contributions, brother. This is going to be really amazing. So my entire team works for the entire year to put this golf tournament on, and it's not something that we outsource. Like every person in my team is a part of a committee to put this golf tournament on. So it's really something that we care a lot about, and that's the main fundraiser for us. To go out, build new construction homes, and to give them to needy veterans in the local community. So this is the 4th annual JWB charity golf tournament. This is the 3rd year that we're able to raise enough money so that we could build a new construction home and donate it to a veteran who has served our country admirably and needs a helping hand. And so that's why this month is incredible, because it leads right up to that. The home donation is actually going to be on March 2nd. This gentleman has been selected, and he is going to be able to walk through the threshold of his brand new construction home that's been given to him. And it's an incredible moment. So a lot of our clients are a very big part of this. We have sponsorships, and we have other ways for clients to become a part of this. And I wanted to let all of you know, if this is something that you'd like to join us on our mission, we would certainly love to have your support. Because as we think about where we are this year, we are so blessed to be able to have the network that we have to raise this type of money, to do this good in the community. But our plans are to do more than one house a year. And that's totally dependent on how many sponsorship and how many donations we can get. We think there's a real chance that in 2022, we can do 2 brand new construction homes that we build and donate to 2 very deserving folks in our community. And so I wanted to ask for anybody who wanted to be a part of that and to help us on our mission to donate. And we have a special way to donate this year. Pablo, if you wouldn't mind, go ahead and put the link in the chat. The link is jwbcares.org/events. And if you go there, you check the middle of the page, you'll see that we are promoting our raffle. And the raffle is a great way for you to get involved. It's a 50-50 raffle. All the money that we raise, half of it will be going to JWB Cares to go ahead and build new construction homes to donate. And the other half will be going to you if you're the lucky winner. So you can donate. Each ticket is $10, and that gives you one chance to win the raffle. And if you'd like to donate $100, you get 25 tickets. So 25 chances. And, on our call yesterday with our clients, a lot of folks raised their hands, said they'd love to donate. So super appreciative for all of you who have already donated. And, it means a lot to us. As I mentioned, we have big plans for this charity that we have. And this giving is such a life-changing moment for me and for all of our team that, we're super happy to have all of your support. So thank you in advance.
Awesome. Awesome, Greg. I think it's so cool that you guys do this. I think I've met the gentleman that received it, of your anecdote and the gem, like the gemologist, all the stuff. It's amazing. I hope people I put the link in the chat. I hope y'all can join in on the raffle. Maybe you get lucky, maybe make some money, but either way, it's going to an amazing cause. Now, Greg, give me the big reveal, man. What does the future hold, and what is your recommendation as an investor that's looking at this asset class?
Well, so when we have just looked at where pricing is and the expectation that JWB has that prices are going to go up in the future, we need to be thinking about what is that going to be doing to my return on investment. right? Because if you look at prices rising 8 to 10%, a common question is, what will happen with rents? Will rents keep up with that type of price increase? And we don't expect that to happen. So you got prices going up, rents are going to go up, but it's not going to be as much, right? And when you have prices going up, what's going to happen is that's going to decrease your cash flow on your investment. All right. The positive cash flow that you've come to know and love really is going to become more of a luxury than a requirement when it comes to this asset class. Because the other thing we have to consider is interest rates. We talked about how interest rates are incredibly low. And Pablo, you were able to close in the 3%, along with another one of our guests on the show. Well, that's really cool. What happens in future years when your interest rates go back up? They're going to go up at some point. They've never been this low. What happens when they go up to 5%? And what's going to happen is it's called cap rate compression. And I wanted to give people some perspective on investing in rental properties, right? People have been investing in rental properties for decades, but this idea of getting positive cash flow is a relatively new concept, right? The most successful rental property investors over the years have invested because of all 5 of the profit centers. But really over the last decade, investors have paid attention to only one profit center, which has been positive cash flow. Now there's 5 profit centers out there, right? Positive cash flow, tax savings, principal pay down, home price appreciation, and inflation hedging. And people have been only paying attention to positive cash flow. Pablo, do you know which of the 5 is the greatest factor when it comes to your overall return on investment?
I do, Greg. It happens to be home price appreciation.
There you go. It's home price appreciation is actually the biggest factor, especially when you use financing, right? So, and that's not to say that you have to focus 100% on home price appreciation, but that just should give you some insight to know that it's not all about positive cash flow, right? Books have been written for decades about the idea of just buying an asset that's going to pay for itself and holding on for the long haul, which is what we preach here. And that over time, especially if you use debt effectively, you're going to wind up with a great return on investment and control of your financial future in whatever you invest through rental properties. So that's really where I see us going. And I'm thinking years in the future now, right? I'm thinking that you're going to see cash flows compress. You're going to see cash flow become a luxury. And the really cool thing is that if you look at all 5 of the profit centers and you compare your estimated return on investment for all 5 of the profit centers, even if cash flows decrease substantially, you're still going to have a pretty good argument that there's a place for rental properties in your portfolio compared to the stock markets or bonds, especially, right? Or other investment asset classes. So I think that's where it's going to go long term. You're going to see rising home prices and interest rates, especially over the next coming years, start to decrease cash flows. And I should probably point out that JWB is well positioned for this, right? We have seen this coming for years and years and years. That's why we have bought so much land that we are building out right now, which has positive cash flow in it. So I don't want people to feel like this is a doomsday scenario where JWB is not going to have cash flow and positive cash flow for you. We do, and we do. We're always thinking years in advance. But those cash flows will become smaller, even for JWB. And I think for those of us who are investing in other markets right now, I really want you to be listening, because other markets and other turnkey providers are not as well equipped to handle this. And you might know this because this is why when you go to those other markets and those other providers right now, they say, sounds great, I'd love to sell you a property, but I don't have one, so I'm going to put you on a waiting list. And what you're going to see over time is that a lot of the folks that ran into the turnkey space over the last couple of years as turnkey providers are going to exit that space. They're going to do other things in real estate because they just can't make the numbers work. And as a business, you just can't survive for that long by putting people on waiting lists. So I think your investments here in Jacksonville, we are in a great place. We have cash flow, we have positive cash flow. You're going to be able to benefit from all 5 profit centers. You should expect that prices will be going up. You should expect that cash flows are going to be coming down slightly. And the biggest thing is that a lot of people have this idea that they're going to put a certain amount of money into rental properties. And if you're one of those people and you say, I've been planning on buying one house a year for the next 5 years, that is the biggest opportunity, I think, to help somebody make a better return on their investment. Because when you look at low interest rates right now and low prices today compared to what they will be, if you just reposition that same amount of money that you had targeted to spend in rental properties and you front load it, you're going to have much better returns from all 5 profit centers today than you most likely will 1 year from now, 2 years from now, 3 years from now.
You spoke for 5 minutes, Gregg. I'm going to succinctly say this as this asset class will continue to perform in the future. When you look around, it's still going to have really, really attractive qualities, but today it happens to be more attractive than it'll be tomorrow, and tomorrow it'll be more attractive than it'll be the day after, right? So it is a window of time that we've lived in that makes this thing particularly attractive. And that window is now starting to close, and it will come a little bit back down to earth, but it'll still perform well, and there will always be a place for it in your portfolio. It's just that right now the getting's good.
Exactly.
Okay, cool. Awesome. By the way, that's why I bought. All right, Gregg, let's go. Do you have a couple extra minutes? All right, let's go 30-second lightning round, rapid fire through some of these questions. There's 8 of them. I think we can get through them quickly if I shut up. Lee Bishop asks, are you still seeing an impressive waiting list from the Jwb lease team?
An impressive waiting list from the Jwb lease team.
You still have a wait list of people looking to get into your properties?
Oh, I wouldn't say we have a waiting list. I mean, when the homes come available, they're all rented within a very short amount of time, and we're performing just like we always have. So we have more leads and more showings than we ever have. So yeah, we're crushing it.
The funnel is full. John Hatcher asks, does the management fee get reduced after owning several rentals?
Great question, John. So yes, once a client gets to 5 properties, we reduce the management fee on a monthly basis from 10% to 9%. And once a client gets to 10 properties purchased with Jwb, we drop it again down from 9% down to 8%.
Awesome. Sean Pointer asks, why would someone not use you as their property management?
That's a great question, Sean.
It's a great. So he puts a little comment. 98% rents received during 2020, 54 months average stay of tenants. Seems like a no-brainer. But in all seriousness, what feedback do you get on people that are deciding between Jwb and someone else?
That's a great question, Sean. Thanks so much for being here, buddy. Sean's one of our spike ball buddies, so I appreciate you being here. You know, I think we offer incredible value on the property management side, so it's hard for me to put myself in a different position, right? I think part of the reason that people invest with us, right? Like properties are properties, in my opinion. Like they're the widgets, right? We do an incredible job of making sure that they're well built and well renovated. But I think the real strength of our team is our team, and an extension of that is our property management and how we handle that. So I think that's the real value. There are some clients out there that would not be a great fit for Jwb on the property management side if they want to be very hands-on. And if they want to be, they want to have a part of like tenant approvals or make a lot of the thousands of decisions that we make every single day. So that would probably be a client that we might just not be able to serve the best. But other than that, I don't know. Your guess is as good as mine, brother. Okay.
My favorite topic. Margaret Smith asks, how much of this sales increase could be attributed to COVID and higher taxes in Northeastern United States? Is Jacksonville attracting folks from the North? And is this permanent?
Pablo, why don't you handle that one, brother?
Sure, man. Margaret, I might not be moving from the North, but Miami, if you consider it, it is much more of a northern type of city than the rest of Florida or the rest of the South, right? Like I moved here as part of this ongoing trend of migration of people that understand that in this untethered digital world, you can work from anywhere. And there happen to be places that you live that have unbelievable, spectacular weather, a super high quality of life, and way more opportunity today than they used to have in the past. And I see Jacksonville as the quintessential place for that, right? I lived in Southern California for 5 years, from 2004 to 2009. And my quality of life here in Jacksonville is what I had in Orange County, Huntington Beach, California, at 60% the cost of it. So if you ask me, COVID has really rapidly accelerated a bunch of trends that were already happening, right? This like untethering, the educational system's getting disrupted. There's all these work from home is happening, right? Like making friends online is happening at scale, which helps my business. But I think that these are all trends that were coming down the pipe. I think COVID has really steepened that curve of adoption by like 5 to 10 years. So if you ask me, I think that this is permanent. I think that I am one sample size of many that will continue. And if you ask me, are people moving here from the north? You can very tangibly feel it daily here in Jacksonville right now.
You can. And there's a lot of numbers to support what you're saying there, Pablo. If you look at the net migration from states to states, Florida and Texas are the two states that have benefited the most from in-migration. In-migration means population increases. People are moving here from other states. And it's no surprise where they're moving from, right? A lot of it's in the Northeast. A lot of people leaving California as well. And they're coming to places largely like Jacksonville. And so there hasn't been a single asset class that has benefited more than single family rental properties from COVID in Florida. Like there hasn't been a place that's benefited more because Florida has largely been open and real estate has been open as well. So there's a lot of numbers to back that up. And so people have been coming to Jacksonville even prior to COVID, right? It's not a new thing,
Correct.
Right? We were one of the top 10 growing metropolitans, statistical areas even before COVID. Now it's accelerated, just like Pablo was saying.
Yeah. Listen, my youngest cousin is a thriving entrepreneur living in San Diego, loving his life. Took a call with him last week. He's like, dude, I'm thinking about moving to Jacksonville. Like, this makes so much sense. All right. Marilyn Cotterman, are you still doing the private lending? Oh, sorry. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
All right. Are you still doing the private lending program for new build homes?
We are doing private lending, Marilyn. So if you have any questions, go ahead and reach out to our team and we'll be happy to talk to you about those private lending opportunities.
Cool. I also want to give a shout out to Kathy Mahoney and to Leo, who have all donated to the raffle, by the way. So thank you.
Thank you guys so much. That means so much to me. I appreciate it.
And Ken Moline asks, are donations to the 50/50 charity tax deductible?
Yeah.
Sweet.
Yeah.
No downside.
It's a donation.
Nadine Shah, how long does it take to close on a property from start to finish?
How long does it take from start to finish? From the time that you put your property under contract to the time you get to the closing table, generally about 45 to 60 days. And that's assuming that you have conventional financing in place. And, that's largely driven by how quickly you get your documentation in. It can be closer to 45 or it can be closer to 60.
I was in the closer to 60 range because I am a scattered person. Mike Foster asks, the moral of this overview is buy and lock in now because interest rates are low and home prices are affordable, ?
Yeah, I think you nailed it. I just see a great opportunity as a steward of your money, which is how I want to be for you. I see a huge opportunity for you to take that same pile of money that you had planned to put in rental properties and to buy them now. And if you do that, the interest rates have never been lower. We think prices are lower today than what they will be. And then hold on for a full market cycle, especially because you have 4% debt on these properties. I think that is going to pave the way for a lot of generational wealth.
All right, we're about to knock this out, man. Leo asks, if the tenant signs 2 years but moves out before the lease, let's say less than a year, when JWB put a new tenant, does the owner will be charged for new placement tenant fee? All right, so does the owner get, you got that?
I got that. Yes. What he's talking about is a scenario that it doesn't work out 100% the way we want, right? If we sign a 2-year lease and then a year and a half into it, somebody has to leave for whatever reason, right? We talk a lot about the risks of investing in rental property. So before you come on board with our team, we're going to talk a lot about this. I mean, of course, we have metrics over time. We've seen how this has performed. We build all this into the expectations with you. But yes, at the end of the day, if that was to happen, you would have a new tenant placement fee because we do have to put in a lot of work to find a new resident for you if somebody would leave ahead of time.
Cool. Miguel Angel had a very similar question. So Miguel Angel, that answers that one. Margaret Smith coming at us with more great questions. Wondering if you can give us a very simple comparison of buying and holding a home with JWB versus a stable performing stock with dividends over the same period.
Well, I guess my first question would be stable, consistent stock. I mean, what would that be? Here's kind of the best scenario, right? So let's talk about everything not named home price appreciation for rental property investing, right? Your returns are between 8 to 10%. That's based on we'll call it the dividend coming in every single month, and based on some tax savings, and based on the resident paying your loan down for you, right? So if you're comparing 8 to 10% for those three profit centers, you can compare that to a dividend in the stock market. Hard to get an 8% dividend in the stock market. I don't know of a stock that gives an 8% dividend right there. So It's also hard for stocks to be as consistent of a performer as what you see with rental properties, especially looking here at 98% rent collection for 2020. So I would say you can compare that apples to apples, 8 to 10% for the dividend portion of rental properties, meaning the rent collection and the principal pay down and the tax savings, compared to probably a lesser dividend. I don't know. You could probably find a dividend for 3%, 4% or so on the high side for some stocks that provide dividends, which are not all that many. But the other thing to consider here is the beautiful power of leverage in a growth market, right? In rental properties, Margaret, you're able to buy an asset, but only put a percentage down on the asset. Let's just say that it's 25% down, right? So when that happens and the market value goes up 4% in that year, but you only put 25% down, that means that your return on that appreciation is actually 16%. 16% return just from that appreciation, right? We haven't even talked about the dividend part of it yet, meaning the rental income and the principal pay down and the tax savings. We're just talking about the appreciation part of it, right? So that's why it's so important for you to invest in a growth market. Now, if we go and compare that to the stock market, you don't have the ability to get leverage. You don't have the ability to put 25% down on a stock, right? So in order to compare it, you would have to get 16% appreciation on the stock price to equate to the same return on investment that you would get from appreciation in a rental property that you use smart debt on. So hopefully that kind of breaks it down a little bit and gives you a little bit of an apples to apples comparison. But that's why these 5 profit centers in rental property investing can be so powerful, especially if you master and understand how to use smart debt, right? It can be a huge generational wealth creation opportunity for you.
Dude, you nailed that one, man. I love the comparison of the dividend is the ROI that you guarantee. And at the end of the day, the appreciation is the idea of, does a stock go up and down? And you nailed it, man. Really, really well done. Last question, super easy, from Lee Bishop. Do you still run at 5 a.m. on Tuesdays and Thursdays? Tell them about this morning run.
We do, brother. We do. We'd love to have anybody who wants to join us as well. We actually go live in Clubhouse, which is a newfangled app that all the kids are doing here. Yeah, Pablo and I run every Tuesday and Thursday morning. And then on Thursdays at 5:30 Eastern, we go live in Clubhouse and we talk. Our room is called Active Health, Passive Wealth.
Active life, passive income, bro.
Nailed it. Carry the niner. Yes. So we go running. We would love all of you to join. You can just find us in the Clubhouse app. How do they find us, Pablo?
Man, I have no idea. You just got to go in Clubhouse at 5 a.m. and you'll see us. Like if you follow Greg or me on Clubhouse, you'll find it. But listen, more importantly, Clubhouse, Schmubhouse, join us in the Facebook group, right? Go to jwbfacebookgroup.com. We are up to 2,300 investors in there and people that like to help each other out, just like the folks that join in this call. This has been amazing. We have still 40 people with us, Greg. We had 50 plus at one point. I can't believe that everybody hangs out with us on a Tuesday. It is so, I feel so blessed to be surrounded by this community and for this opportunity. Join us on Thursday for the JWB Rental Income Property of the Week. Where we're going to break down nuts and bolts, something from the inventory at JWB so you can really, really just up your rental property income analyzing game. That's it for me, man. I'll leave it up to you. I'm sweating over here.
Yeah, man, it's been a great call. Thank you to everybody. And just a little teaser for the property of the week on Thursday, just put it together and we're going to be featuring a brand new construction property. So it hasn't been something we featured in quite a while. So if you'd like to see how a brand new construction property works from a rental income perspective, join us for the Thursday show. And with that, we're out, my friend. Thank you, everybody.